Hi, my name is Sofiya. So, what is financial market? Financial market is a market that serves as a link between the savers and borrowers by transferring the capital or money from those who have surplus amount of money to those who are in need of money or investment. Financial market can be divided into two broad categories which are money market and capital market. So, money market is the financial marketplace where short-term borrowing and lending of funds have maturity periods of less than 1 year occur among banks, financial institutions, corporations and government. It facilitates the raising of short-term funds for meeting short-duration needs. Participants that involve in money market are commercial banks, central banks, corporations, financial institutions and government. For commercial banks, they participate for short-term liquidity management and to lend excess funds. For central banks, they influence the money market through monetary policy operations, setting interest rates and regulating liquidity. For corporation, they use the money market to manage their short-term cash flow requirement and to invest surplus funds. For financial institutions, non-bank financial institutions like insurance companies and pension funds also participate in the money market for short-term investment opportunities. Last but not least, government, they use the money market to finance their short-term cash flow needs and to manage their liquidity. Money market important to economic stability, interest rate transmission and financial market operation. For economic stability, efficient money market contribute to overall economic stability by facilitating smooth short-term funding and liquidity management. For interest rate transmission, changes in money market rates influence broader interest rates, impacting borrowing and lending decisions in the economy. For financial market operations, the money market acts as a crucial link between various financial institutions, ensuring the efficient allocation of funds.
Money market examples. One of it are treasury bills. Treasury bills is short-term debt instruments or promissory notes that are issued by the government. Think of treasury bills like loans you give to the government. When you buy a treasury bill, you are basically lending money to the government for a short period like a few months or up to a year. In Malaysia, they call these treasury bills as Malaysian Treasury Bills, MTB. When you lend money for a longer time, like a couple of years or more, it is called Malaysian Government Securities, MGS. Now here's the twist. Instead of giving you interest payments like a regular loan, the government sells these bills at a discount, which means you pay less than what they are worth when they mature. When the bill matures, the government pays you the full amount. For example, if you buy 100 ringgit treasury bills at a discount, you might pay only 95 ringgit for it. When the bill matures, the government gives you the full amount of 100. That difference between what you paid and what you get back is like the interest you earn on the loan. Next, we have certificates of deposit, like a savings account where you agree to keep your money untouched for a certain time period. Usually, in Malaysia, they are often called fixed deposit. You earn a higher interest rate than a regular savings account because you are committing to keeping your money with the bank for that specific time. When the time is up, you get back your initial deposit plus the interest you have earned. Usually, the longer you leave your money, the higher the interest rate. For example, certificate of deposit are called as fixed deposit. Instead of putting that 10,000 in a regular savings account, you decide to put it in a fixed deposit for 1 year. The bank offers you a higher interest rate of 3% for a 1 year certificate of deposit. After that, your 10,000 ringgit has grown to 10,300 ringgit, which means 300 is considered as interest. In this example, by choosing the fixed deposit option, you have earned more interest compared to the regular savings account because you agreed to leave your money untouched for a specific period. Lastly, we have commercial paper. Commercial paper are unsecured promissory notes for a specified amount to be paid at a specified date and are issued by finance companies, banks, and corporations with excellent credit. In Malaysia, similar financial instruments exist such as Islamic commercial paper, which adheres to Islamic finance principles. These instruments are structured to comply with Sharia law, which prohibits certain elements such as interest, called as riba, and uncertainty, called as gharar. A bank is one of the financial institutions that offers such Islamic financial products. Investors who purchase commercial paper or Islamic commercial paper earn a return on their investment when the paper matures, at which point the issuer pays back the face value of the paper. Since commercial paper is unsecured, investors rely on the creditworthiness of the issuer. Generally, only companies with excellent credit ratings are able to issue commercial paper at favorable terms.
Next, I would like to explain about capital market. Capital market is the markets that deals with the selling and a buying of a long-term securities that have maturity periods of more than 1 year. Capital market securities are more risky compared to the securities in the money markets due to its long-term nature. Capital market is also commonly used by companies to make capital investment. There are two examples. First, bonds, debentures, preference shares, and ordinary share. Second example, the capital market encompasses the development of financial institutions, EPF. These long-term securities are traded in two types of market, which is the primary market and secondary market. Now, I would like to explain about primary market. First, primary market is the market for companies to sell a new securities to acquire capital. This sale is an initial public offering IPO. Second, transactions directly occur between the investor and the company issuing securities. Lastly, companies that intend to issue shares will release a prospectus that provide information on the company to enable investors to evaluate the company performance.
Hi, my name is Athirah, and I will be presenting about the second type of capital market, which is secondary market. So, what is secondary market? Secondary market is a financial marketplace where the previously issued securities, or also known as existing securities, such as stocks, bonds, derivatives, and financial instruments, are bought and sold by the investors. It provides liquidity to the investors by allowing them to buy and sell securities after their initial issuance. The transactions occur in this market are only between the investors without involving the company that issued the securities. For instance, if you want to buy Apple stock, you will purchase the stock from investors who already own the stock rather than Apple. Apple will not be involved in the transaction. Next, the examples of secondary markets are Bursa Malaysia, the Malaysian Exchange of Securities Dealing and Automated Quotation, MASDAQ, and Malaysia Derivatives Exchange Berhad, MDEX.